Hey there, great people. Thanks so much for dialing in. Touching base to let you know that as with all of our content, this is general in nature. It does not take into account your specific or personal circumstances nor your individual risk profile, and as such should not be acted on accordingly. If you get value from this and you want to explore some things further, I strongly recommend that you get personal advice from a qualified professional.
Hello and welcome. Today we've got a very, very special guest, David Bassanese. Hopefully I'm pronouncing that right, David. Financial columnist at the Australian Financial Review. Worked for Treasury and the government at times as well. And now you're the chief economist at BetaShares, which we like here at Apex Advice. So thanks for dialing in, Dave.
Great to be with you, John.
So, Dave, I just wanted to start a bit around your origin story. I just wanted to understand, what got you interested in finance and economics, and just sort of take us on a bit of a journey on, where you've been in your origins.
Wow, okay, that's going back a little while. I mean, to be honest, it starts way back in high school. Quick little stories that I was doing maths 1 and 2. I don't know if people remember doing classes at high school.
Yeah.
And I was in year 11 doing maths 1 and 2, and because I thought I liked maths and it was too much maths, I had to drop one of those. And they said, oh, well, if you got to pick up a subject. And they said, the first time I've ever heard of it, there's a subject called economics you can pick up. And I said, oh, what's that? I said, oh, it's about money. I said, oh, all right, sounds all right. And so I started doing economics in year 11, and I found it, I really got to it, understood it, enjoyed it. So I just took it on from there, studied economics at uni. As you mentioned, went and worked at Treasury. When you come from Adelaide, as I do, you get groups like the RBA and the public service knocking on your door and accountants for jobs. Of those, you don't get the sexy merchant banks from Sydney coming all the way to Adelaide, but you do get Treasury and Reserve Bank and those groups. And Treasury offered me a job, and so I moved to Canberra and, became a macroeconomist, and the rest is history, as they say.
Yeah, fantastic, great lead. And being Adelaide born and bred, are you a Power or Crows, or neither?
Look, I've been out of Adelaide for so long. I'm more a Sydney Swans supporter nowadays, though I do have a soft spot for the Adelaide teams, when they are playing other teams, certainly for the grand final. But hand on heart, if the Crows or the Port are playing Sydney these days, I'm kind of barracking for Sydney, I find myself. So just the way, been here for 20 odd years. So, more or less the home, probably almost lived as much in Sydney now as I've lived, because I did live overseas for a while. So I've probably lived outside of Adelaide longer than I've lived in Adelaide.
Yeah, fantastic. Well, couple of good decades, much like the share market, Dave. So, look, just want to get your initial thoughts around the current economic landscape. Just what I know things are changing quite rapidly in the economy, but just with everything going on economically, we've got rising costs, cost of living crunch, volatile share markets and other markets. What do you see as the biggest challenges and conversely opportunities for investors and people today?
Yeah, look, firstly, I mean, the major macro backdrop here is, still recovering from COVID, dealing with the surge in inflation that we got during COVID, where they had a lot of supply-demand imbalances. And really, the good news is the soft landing scenario. If you've heard that term, basically what that means is, we've had inflation come down quite nicely over the past 18 months without the recession that many feared that we would need, particularly in the US. So we've been living in that soft landing scenario, and which has been positive for equities. It's sort of been a bit more mixed for bonds, but bonds are starting, with central banks starting to cut rates, fixed rate bonds are starting to improve as well. So that's been the big story. Now for Australia, on top of that, we've had obviously the China slowdown, which has been hurting commodity prices. It's been, I guess, undermining our resource performance. So our share market has been lagging, whereas global markets, particularly the US market, let's say, has been doing very well. So you've got the soft landing, you've got the China slowdown. The other thing going on In Australia, of course, inflation has come down, but it's a little bit stickier than what we're seeing in the United States. And so why the Fed, the US central bank, has managed to cut rates already, we're kind of like waiting for Godot. That's the old play, waiting for Godot. We're waiting for inflation to come down by enough for the RBA to be able to cut rates. It hasn't happened yet. We've got some stickiness still in things like financial insurance, housing, rents, which, if they come down, I think the RBA can start to cut rates next year, but we're sort of waiting for that at the moment. And meanwhile, the economy, is not in recession, but it's subdued. The consumer spending in particular is subdued, but other areas are holding up. We've had a big immigration rebound, of course. Last but not least, the new, I guess, variant, new issue to deal with is the return of Donald Trump and the so-called Trump trades. And really, what we're talking about there is, tax cuts, fiscal stimulus, which will add to demand in the US, potentially reignite inflation, potentially put upward pressure on bond yields. And if bond yields sell off badly enough, then it could actually hurt the equity market. But at the moment, the equity market is celebrating, the tax cuts and the stimulus being provided by Donald Trump, the promise of deregulation as well. On the back burner is, what he does in terms of trade wars, increasing tariffs and stuff like this. So there's a few. So it's a mixed picture from emerging from Trump. But at the moment, equity markets are rallying. Bitcoin is rallying. Tesla is rallying. So anything within the orbit of Donald Trump is doing well at the moment.
Yeah. And I think I saw a publication from you guys at BetaShares. It just I think it said Eisenhower introduced the S&P 500 back in the 50s, and you'd sort of track the weighted average return of the Democrats and the Republicans over that time, and it showed like a nominal sort of difference over that time. So what sort of I guess overarching, what actual sort of impact do you think, say, Trump will have on sort of global share markets and locally? Does it have much of an impact? Is it all a bit of a blow up, or what's your sort of sentiments?
Look, I think so. There are positives and negatives. So the positives of Donald Trump from a market perspective is the promise of tax cuts, cutting the corporate tax rate in the US from 20 to 15%. Not cutting taxes for households, but basically there was an automatic increase. There was a temporary tax cut for households that was due to end next year. Now, he said he's going to make it permanent. So it's not a tax cut for households per se. It's just avoiding the increase in taxes that would otherwise have happened. He's also pro-deregulation, for good or bad, depending on where you are, but markets like that. And I said the tariff and trade tensions potentially are the negatives. Now, on balance, the biggest concern from a macro perspective is really inflation and the bond yields. I mean, if Trump causes inflation to go back up again and bond yields, we may get a repeat of 22. Bond yields went up, and it really then hurt the equity market, hurt valuations in the equity market. So the equity market at the moment is happy because, the global economy is not in recession. But if bond yields start going up again, we may get, that it may spill over into the equity market. So that's the concern at the moment. On balance, though, I think, equity markets did rally through Trump 1.0. So I still think on balance, they will, continue to rally through Trump 2.0. So I'm still positive on equities, a little bit more mixed and guarded, I think, about fixed rate bonds in the short run. So the key takeaway from Trump is equities still okay, bonds probably still okay, but a bit more risk. And the US, and I was counting on the Aussie dollar strengthening over the coming year because the Fed would be cutting rates more aggressively than we will. Now with Trump and fiscal stimulus, maybe the US dollar remains strong and Aussie doesn't get that bounce that it would have otherwise got. So they are the sort of things going on at the moment.
Yeah, gotcha. So it sounds like Trump, pro-business, helps with profitability if they're paying less tax and that sort of stuff. And he's also trying to slow down a bit of globalisation and do a bit more nationally for them. What sort of, speaking sectors in Australia, like what are the main ones you think will be impacted by Trump and his tariffs and these sorts of things?
Well, look, I guess our two big sectors are mining, the resources sector and the banking sector. So over the past year, I'm sure as your viewers would know, the banking sector has been on a tear. It's done very well because we feared a recession that didn't happen. But the resources sector has been hurt by the Chinese slowdown. But I think the Trump impact is not going to be positive for resources. I mean, anything that makes it more challenging for the Chinese economy is not going to be positive. I mean, the counter to that is, some suggesting that the pressures from Trump might cause the Chinese government to stimulate the economy even more. I'm not sure they can really just stimulate their way out of their problems, through fiscal stimulus. But so that's going to be a challenge. I still think our overall market, it's really the inflation in Australia is going to be the big driver of the share market here. If it comes down, as I think it will, and the RBA is able to flip the switch to cutting interest rates, that's going to support, domestic sectors, probably continue to support the banking sector, support a recovery in earnings, maybe to catch up with the share market that's been doing well at the moment. So, So bottom line is, Trump is a new risk factor for China and hence a new risk factor for our resources sector. But otherwise, we're really in the hands of inflation and the RBA.
Yeah, fantastic summary about the impact of Trump. It's such a hot topic. And just on that interest rate conversation, that one's even hotter. I think there wouldn't be a person I speak to that wouldn't have an opinion or want to know something. So just with our interest rate landscape, David, like what do you see? A lot of people are feeling the pinch with rates being high, especially those on their home mortgage and that sort of stuff. So I guess, what's your professional perspective on where rates are heading and how everyday investors should think about this environment?
Yeah, so at the moment, the government has obviously introduced some cost of living relief measures. It's helped reduce electricity prices in a major way. So headline consumer prices in Australia are currently on a year-on-year basis back within the RBA's 2 to 3% band. I mean, the Treasurer has made point of that. But again, it's distorted by these electricity subsidies. The RBA is focusing on the underlying measure of inflation. That is still at 3.5% on an annual basis. That's the quarterly number. We also get a monthly number that actually came out in September at 3.2. So so the quarterly number is at 3.5. The monthly is at 3.2. So it's still above the RBA's target, but it has been coming down. And so I'm waiting for the December quarter CPI, which comes out in late January. And if it shows that quarterly underlying inflation measure has gone from 3.5 to, say, 3.25, I think that'll be enough for the RBA to at least start to cut interest rates, maybe cut rates in February. Now, if it doesn't go down, if it stays at 3.5, we're not going to get that relief. It just won't be able to provide it. So it really comes down to that inflation. Your interest rate outlook is as good as your inflation forecast at the moment. And so I think interest rates will be cut, but, it is crucially dependent on inflation continuing to come down. It's not yet come down. Well, it has come down, but not by enough to allow the RBA to start to cut rates. Just on that, I mean, the thing about the economy overall, I mean, this is maybe something. There's a lot of focus, a lot of media attention about the weakness of consumer spending, the pressure on households that have a mortgage. And without question, consumer spending, certainly on a per person basis in Australia, is very weak. But the overall economy, there's two elements. Other parts of the economy are actually holding up, like infrastructure spending's doing well. Immigration is underpinning a big rebound in tourism, international education. So there are other parts of the economy actually holding up. And of course, there's a big swathe of households that don't have mortgages. Obviously, renters are under pressure from rising rents, but for the 1/3 of households that don't own their own home outright and rely on interest income, they're actually, at the moment doing okay from the rate increase in interest rates. So it is a mixed picture. It's not all negative, but on balance, I mean, unfortunately, the RBA says, look, we've got one instrument. If we need to slow the economy, all we can do is raise rates, which hurts a segment of the population. Maybe not that fair in the way it operates, but unfortunately, that's, as the RBA says, it's the only instrument they've got. But so I wouldn't count on relief. Well, I would count on relief hopefully by mid-year for those with a mortgage. And I think with the subdued consumer spending that we've got at the moment, it is bearing down on inflation. It's just taking a little bit longer than what we've seen in some other countries.
Yeah, okay. And what are you seeing with like savings rates and that sort of stuff? Like, is that my understanding, we built a big pile of cash up through COVID, and then has that sort of dwindled, or are you finding that's maintaining? What are you seeing there?
The numbers suggest we've been eating into our savings. So basically, we got a lot of income through COVID. We didn't have a lot of opportunity to spend that money. Yeah. People were cautious, and so the savings rate went through the roof, and there was an accumulation of savings. And so the savings rate went up. What's called the household savings rate in the national accounts went way above its long run average. At the moment, it's well down. So it's basically we are now eating into those savings buffers that we built up. Though the estimates suggest there's still quite a substantial buffer there. So there is still a ways to go. So households, at least according to the numbers, have that buffer to spend if they want to. But because of, caution, they have been, they have been eating into it, but there's still, some left. So there's still some capacity. Now, one of the ways in which they've been eating into that savings buffer is to increase their mortgage repayments. And so you've seen many people, to the extent they've got some spare cash or they've cut back on spending, they're using that cash to help pay down their mortgage. Yeah, okay. But there is that buffer. There. It's been one of the reasons why, if for example, if the household savings rate didn't go down in the last few years, we've had an absolute crash in real incomes, certainly real incomes per person. Inflation went off. Incomes didn't keep up. Real income wages didn't keep up. And so real incomes have come down. Now, if household spending fully followed what happened to income, we would be in recession, no question. But they've managed to buffer some of that decline in income through running down their saving.
Yeah. And I assume in terms of interest rates trajectory, we've seen a really steep increase. And then when we start seeing some decreases, I doubt we'll see, all things being equal, such a rapid decline, unfortunately. But hopefully there's a bit of relief on the way, David. In terms of, like, for those wanting to position themselves for growth, where do you see the most promising opportunities right now, sector-wise, trends you think investors should keep on their radar? What would you sort of say are areas of growth?
Yeah, look, if you think about it from an asset class point of view, I mean, the soft landing scenario, as I talked about earlier, is generally good for bonds, good for equity. So basically, if interest rates come down, if central banks, notwithstanding Trump being a new risk factor, but if ultimately central banks are now on the path toward cutting rates back to more normal levels, then bonds should do okay. So fixed rate bonds, if we get a 1% decline in bond yields, given current yields, you get almost getting like a double-digit return on bonds on a total return basis, the income plus the capital growth. In terms of the equity market, look, it's really been, the global market, you can actually summarize, you've had the large cap tech companies, the Googles, the Amazons and Facebooks, the Mag 7 have been dominating. It's like they've been outperforming almost everything else. Our banks have been doing well within our market, but globally it's been US tech versus the rest. And the big question is, will we get a rotation to other areas of the market which look very cheap? I think under Donald Trump, small caps are looking interesting. So US small cap The US market, I think, is going to probably continue to outperform in global markets, but you might get a rotation within the US market from the large cap tech companies to some of the smaller mid cap parts of the market. So like a US equal, one ETF we have is an equal weight, for example, tracks the S&P 500, but it weights all the companies equally. So you get a much less exposure to those large cap, at the moment, relatively expensive companies. So that's a way to have US exposure with less, concentration risk, if you like, in the large cap tech companies. Within Australia, I mean, funnily enough, in Australia, we've got a very vibrant technology sector in Australia as well. It's about 2.5% of our market, unfortunately. So it's a very small part of our market, but it's been doing very well. And also companies, what we consider what's called quality companies with high return on equity. And you can basically screen for those sort of companies within the market. So there are two areas in the Australian market which have been doing well. And again, there are ETFs. We have some ETFs in that area as well, Australian technology companies and Australian quality companies. So I like mid-small caps, particularly in the US. And in Australia, I still like the tech area with interest rates eventually coming down and companies with strong balance sheets and good profitability across sectors. So again, this is what's called a factor. So it basically picks the best companies using that characteristic across all sectors. So just a few ideas there.
Yeah, that's fantastic. And just back to that global versus domestic landscape, obviously we're, a really small part of the world, in terms of our share market and economically. However, I'm just keen to get your thoughts, talking through, Aussie versus international sort of markets. And when you think about after-tax returns and things like franking credits, how do you, what do you sort of favour, or do you just espouse the virtues of diversifying and asset allocation and that sort of stuff?
Well, look, it really depends what you're seeking. I mean, if you're seeking, franked income, dividends and good franking, you can't go past the Australian market, right? I mean, you're only going to get it here, and we've got a pretty good dividend yield. The banks have had a great run. They, look expensive from an historic point of view, but maybe earnings can catch up. Maybe they've run ahead in anticipation of the economy eventually rebounding and then earnings catching up. So again, if you want income, we've got the strongest, pretty, I don't know, I wouldn't say low risk, but I mean, our banks are pretty simple in their models now. They're basically, mortgage, a big chunk of their business is mortgages, have very dominant position. If you're looking for growth though, to your point, I mean, as a thematic, I still favour global markets, particularly the US market, outperforming Australia. And that's because if you look at the earnings outlook for our market versus the globe, it's still stronger globally. So the expected earnings growth on a 12-month view, for example, globally is something like 12%. In Australia, it's more like 6 or 7%. And we've had downgrades to the earnings outlook at the moment. So even that number is under pressure. Meanwhile, valuations, courtesy of the banks rallying, I mean, our market is not especially cheap to global markets. So you might want to favour our market if you thought it was, even with a weaker earnings outlook, if our market was cheap enough, you'd like it. But it's actually not that cheap. It's trading at just over 18 times forward earnings, which is similar to what global markets are trading at. So on a relative valuation basis, we're closer to fair value, if you like, relative to global markets rather than cheap.
Yeah, sort of fully pot. Okay, great. And just to wrap up, a bit of a different one for you, David. Just being a bit nostalgic, but what's a sort of a personal finance lesson or philosophy that's stuck with you throughout your career or served you well?
To be honest, I mean, I discovered ETFs, over a decade ago. In the US and they came here. I mean, I love the diversification that ETFs give you, and if you're a stock picker, great. But I've never been a great stock picker. So I love the diversification one can get through ETFs and picking, like, the US market or tech or a different sector. So that's been my one lesson, is to not. It's almost like tying yourself to the mast and not hearing the siren song to chase a hot stock. And I'm not saying don't do that. It's just not my skill set. I've got to remember, don't chase the hot stock. Keep your asset allocation. Play it from a top-down global macro perspective. Has been a lesson, because every now and again someone will give you an idea for a stock, and then you got to watch it. And if the market sells off and the stock sells off, you're not sure if it's just the market or is there something new about the stock you need to worry about. So that's been a key lesson with investment markets. Paying off my home loan. I think anyone who's got a home loan, you don't get any tax benefits from the interest you pay on a home loan. So that always is was been a focus of mine earlier. But yeah, that's pretty much it. Have good debt, not bad debt, and be well diversified. In the equity market.
Yeah, that's brilliant. And we call that, often just say that, like that single stock that's speculating, not investing. Investing is buying good broad-based things and just leaving time to its thing. So just one more, like a personal bit of advice to your younger self, or anyone who's listening today around building wealth, anything you'd part them with?
Oh, look, the beauty of, again, not to over promote ETFs all the time, but the beauty of what we're getting now with ETFs and or automatic investing, different businesses now allow you to put in, a few $100s a month or whatever, regular investing, start early. It's easier than it was, 20 years ago to invest in a low cost, broad index tracking fund and regularly top up that investment. The technology is now available, so definitely avail yourself of those those facilities now.
Brilliant. Well, thank you so much, David. You're a wealth of knowledge, and I appreciate you taking a bit of time to chat.
No worries, John.